I am, in fact, going to disagree with almost everything that's been said at every stage in this conference so far. And let me give you the short answer. This crisis is not a financial crisis. This crisis is a real crisis, and the financial consequences that people have focused on are a symptom, not a cause of what's going on. From that perspective, when you say, is there going to be another crisis, I think you look around the world at the health of the real economy. We're not out of the first crisis yet by any means. And I think in one obvious area, which I am pleased to say nobody has talked about at all, you can see where the coronary event is going to occur. So I want to start, though, with just to remind you how clueless the central authorities are to what is going on. It's hard to see here, but these lines up here are the successive forecasts of the Fed for the economy going forward since the crisis. This line on the bottom is what's actually happened. That they have systematically, obviously been wrong, but they've been systematically upward biased. And they have not gotten any smarter. The latest example of this were the forecasts that you saw of about 3.5% growth for this year, which are grossly inoperative again on the downside. So clearly something is going on that the Fed, at least in their forecasts, and I assume they have an incentive to try and forecast accurately, have not understood. I'm going to talk about that in two parts. The first obvious possibility is that they are just going after the wrong targets. That what is the heart of the problem is something that nobody is going to talk about, and I'm going to talk about that for the first part of this talk. The second possibility is, of course, that they're systematically overestimating the impact that they have. And I'm going to talk about that too, and essentially reach the conclusion that the one Depression-era reform that Elizabeth Warren decided not to mention because it was bank-friendly, that also got repealed, has in fact rendered the Fed completely impotent to do anything but prevent bank runs, basically, of the sort it did in 2 weeks in October of 2008. So what I'm going to start talking about, because this is a Minsky conference, is something that Hyman Minsky identified that's been largely overlooked here, which is that the notion that balance sheet crises are something novel, I hope has Hyman Minsky rolling over in his grave. Because not only did he identify in qualitative terms a sequence of balance sheet crises, which, by the way, filled an important gap in Keynesian theory. The problem with basic Keynesian models is that they're not cyclical models, that they are models of bad times and then animal spirits somehow come along and you go back to good times, which is scarcely an economic model. The Minsky models, which are based on balance sheet deterioration and recovery, in a way I'm going to talk about in a second, are cyclical models, that they're based on a very long-standing tradition that goes back to the 1960s at the NBER of actually tracking these balance sheet phenomena. And in the late 1970s, there were a set of models that actually put these phenomena in the context of imperfect information in financial markets, which we think is pervasive. So basically, the idea is there is a demand or supply shock. In standard perfect information economics, prices ought to adjust to attenuate that stock in terms of output and real activity. In fact, what goes on, and this is well documented, is that firms continue to produce because they don't know how to interpret the shock. They continue to accumulate capacity that operates with long lags, and their balance sheets deteriorate. Now, in a perfect world, they would fix that balance sheet deterioration by issuing a lot of equity and retiring a lot of debt once you have the debt-financed original investments that take place. In practice, that doesn't happen at all. Equity issue completely evaporates in these crises. You get a short, sharp contraction. they stop investing, they stop producing, they eliminate inventory, they stop investing in human capital. And the inventory and investment reduction is what, over time, restores balance sheets. Now, if you can't sell equity, it is your existing stock of equity that absorbs risk. And in these models, the willingness of firms to, and all institutions really, to invest is driven much more by risk considerations than interest rates. In fact, in the whole history of empirical studies of the effect on interest rates on investment, nobody has ever been able to find an effect. As the balance sheets improve through retained cash flow, as equity accumulates, then all of a sudden they become ready to invest again, ready to expand production, and you get this long, slow recovery phase of the economy. It's a classic Minskyan cycle. In that phase, of course, for informational reasons, if you're a good firm and you want to distinguish yourself from all the run-of-the-mill and crappy firms, the way you do it is the way any real he-man in financial markets does it, is you take on a lot of debt. So there are both tax incentives and informational incentives not to sell equity in the later parts of the cycle, but basically to finance with retained earnings and debt and to pay out dividends to establish your ability to do that. That pushes the companies to the edge, and there are these natural incentives to do it. Then the shock comes again, which is the Minsky moment, and the cycle repeats. That is well-known theory. What's good about that theory is that once you understand it, you should understand that there are also economic contractions that don't look like this at all, that are not self-correcting. The most obvious one of those is the Depression. And you ought to understand how exceptional it was. It is a 3-year contraction. 1930 is a bad year, 1931 is a terrible year, 1932 and early 1933 are bad years. It's nothing like the 6-month to 9-month contraction that you think about. And it's not only a relatively slow recovery, in certain cases it's a non-recovery. There are economies like Argentina that never recover from the Depression. So that it is a much more extended and much more severe crisis where the self-corrective balance sheet phenomena do not seem to operate. The current crisis, I think you'd have to say, looks like that. You've got long-lived contractions, certainly in Italy, Greece, Europe, certainly in Japan, and very slow to non-recoveries. So the question is, what is it that distinguishes these situations from the classic Minsky cycle? And there, I think, you want to look at what happened in the Depression first to think about it. And essentially, the story I'm going to tell is that these long-lived crises are associated with the ultimate collapse of an important sector of the economy. In the Depression, it's agriculture. The farm balance sheets go into the 1920s in terrific shape because from 1900 to 1920, farm prices are very high. They do very well. The 20s are very weak and those balance sheets deteriorate. When you get the price collapse originally in 1929, a peculiar phenomenon happens, and the price collapse occurs just as the long-term negative price trends occur, not because anybody is behaving badly, but because productivity growth in agriculture is 4 to 6% a year, and global demand growth is 2% a year. And it's very price inelastic. You finally get a drop in price. The farm families are impoverished. All their capital is on the farm. They don't have good balance sheets. And what happens because of the failure of capital markets to fund out migration under these circumstances is they stay on the farms and produce more and more. The bizarre aspect of 1930 to 1932 is that outmigration from the farm communities essentially stops. So you have a third of the economically active population of the United States trapped in these communities, and the effect is cumulative. Productivity continues. You don't get rid of the labor. They stay on the farm and work. They produce more and more. Prices get lower. They get impoverished further. The banks in those communities fail, and they are trapped there. Over time, ultimately, as farm prices improve, they start to get out of it, but very slowly. If a third of the population is basically impoverished, that's going to be transmitted to the industrial and urban sector. That the drop in demand from the farm families is going to far more than offset the improvement in demand because food is cheaper under these circumstances. The farm families are constrained, the richer families are not. So the rural collapse gets transmitted to the broader economy. And now even if you wanted to move, the jobs are not going to be there. This is a very difficult phenomenon. And then something happens that you're familiar with from the present crisis. The agricultural countries, the countries in this difficulty, try and export their way out of the problem. You can't support yourself on domestic demand. The way you've got to do it is to devalue your currency, and that's why you see whenever a country goes off the gold standard in the Depression, Argentina, by the way, and Australia do it very early. They get a significant recovery, and they start to recover on that point. The problem is everybody can't devalue. It is a zero-sum game. The exports and imports have to add up to zero. So that is not a strategy, whether it takes place at the tariff level, and by the way, in the Depression, it's much more on the devaluation level, that's not going to enable a global recovery. What is it then that leads to the recovery from this situation? And there I think you have to remember the single greatest failure of traditional Keynesian economics. And it is this. Alvin Hansen and Paul Samuelson and all the other Keynesians were running around talking about how at the end of World War II, the Depression was coming back. And they were wrong. And it's not because there was necessarily accumulated demand for durables, because there are other things going on. It turns out that inadvertently, all over the world, World War II is fabulous industrial policy. It gets everybody off the farms into the cities at government expense. It's not that all the firms, as Perry claimed, are on the government's balance sheet. It's not even close to that. But the incremental additions to capacity are financed by the government all over the world. So that when the war ends, you've got the workers where they have to be, producing the housing to be there, demanding the goods in the short run to be there, that they then get hired to produce, and the economy finally recovers from that, except for Argentina, which does not participate in the war. That's a very different story about what takes place, and it seems to capture a lot of what's going on in the current crisis. The sector that seems to be collapsing for exactly the same quasi-virtuous reasons as agriculture in the Depression is manufacturing. Productivity growth is 5 to 7% a year, and demand growth globally is maybe 2 to 3% a year. And you have this enormous capacity added in Asia mostly from the formerly socialist countries. So that you've got people trying to sustain manufacturing sectors, and I'm going to go through this in detail, by exporting. But you have the same problem that you have in the Depression, which is the sum of the deficits and surpluses has to be zero. Now, you also have a related problem. If you have chronic surplus countries, they accumulate foreign currency assets. And they have to balance the system, invest them overseas. And all the evidence is that when individuals or institutions try and invest overseas, they are almost inevitably dumb money. So that you have a very fraught financial situation where there's a lot of money in the hands of outsiders going to places like the United States. Where is the policy solution this time? Nobody is talking about it. And this crisis, it seems to me, is not going to go away until people at least try and think about it. If you think about the global imbalances to which this gives rise, you can see it country by country. Japan has always wanted to run a big surplus on current account for self-protection reasons. They're a poor, resource-poor country. They want a big margin of safety of exports over imports that under normal circumstances might have been able to be accommodated by the rest of the world. Germany has a powerful manufacturing sector that it cannot support on German demand alone. It has to export. And of course, what's the mechanism by which it controls its currency? The euro is a gift from the gods. They get to destroy all the southern European economies without worrying about the appreciation of the yuan. For China, it is doing classic export-led growth on a scale that we have not seen before. And this is the destabilizing element. That without the growth in that manufacturing sector, ask yourself, what does Chinese growth look like? And the answer is pretty dismal, so that's not going away. Then you've got Korea, Indonesia, Thailand, and Malaysia that used to run deficits. They had to borrow in foreign currency to support those deficits. Countries lost confidence in their ability to pay off those debts. The currencies collapsed. The burdens of the debt doubled in many cases. The companies that issued that debt went bankrupt. You have very severe crises there. But guess what happens? They go from deficit to surplus. And they're never going to deficit again. But somebody still has to eat the surpluses. It went to Russia, Brazil, Mexico. In turn, their currencies collapsed. Ultimately, where do these surpluses have to be eaten? Or do they have to reside? It's the United States. If you think in those terms, the United States does get some help because the flip side of these payment imbalances is that the Chinese are winding up with a lot of dollars. They could buy euros with them. But what would that do? It would drive the euro up to $2. The Europeans were very proud when it got to be $1.65 until they found that at that level it was undermining their exports to the rest of the world. And they weren't so happy with it, so they probably would have to buy up the dollars, but the dollars are going overseas to the surplus countries. Now, people say, oh, what if China decided to get rid of all those dollars? Well, A, they'd have to find somebody to buy them who wouldn't want to buy yuan right back. But B, they are running chronic current account surpluses. So they not only have the $3 trillion, that number is growing at $600 billion a year. And if it didn't grow at $600 billion a year, ask yourself this. What would that deficit do to the Chinese manufacturing sector? And you'll see that they have no good choices. Comes back to the United States in some form. We won't let them buy equities, so they're going to buy fixed income. You see a huge drop in interest rates. They're not happy with what they get in government securities, and they get creative. And trust me, that's what Wall Street feeds off of, is stupid overseas money looking for yield. And they produce, as night follows the day, the mortgages, originally, by the way, for overseas investors. Ultimately, everybody got involved. So the financial instability is driven by the instability in the international imbalances. Now, the non-U.S. countries did not have good choices. Either you ran current account deficits or you accumulated dollar assets. You couldn't do surpluses and not accumulate dollar assets. For the U.S., you're walking a tightrope here. That the benefit side is that you get to print paper and buy real goods. The deficit side is it is very hard to sustain full employment when you are leaking demand overseas at a rate of 6 to 7% of GDP. And what it takes to sustain full employment under those circumstances, well, all right, this is, by the way, the effect of, I'll do this quickly. When you look at what happens in Europe to the sovereign debt, it is not the government deficits that matter, it's the current account deficits. If you're running a current account surplus, and one of the things that Rogoff and Reinhardt did not bother to identify was that there has never been a virgin default by a country that was running a current account surplus. because that means they can finance the government debt domestically. Those are informed investors, and they can do it. So right away, the imbalances lead to fraught positions in sovereign debt markets. But the real problem here is what you see in this diagram. This is the U.S. savings rate. And you can see historically it's 10 to 12. It gradually goes down to about 2.6 in 2005 because that is necessary to sustain full employment, as well as a housing boom being necessary to sustain full employment. When the crisis comes, you can see where the jump is. In 2008, it goes from 3 to 5 and then to 6.1. It's an extraordinary drop in consumer expenditures. That drop in consumer expenditures was inevitable. You can look at these numbers, and I'm going to do a very conservative set of numbers, and then I'll tell you what I think is still going on today. The top 20% has at least 50% of the income. They actually have a lot more. They save 15% of their income. That's a 7.5% savings rate. To get to an overall 4.5 or 3.5% savings rate, it means the bottom 80% of the population that has 50% of the income has to be spending 107% of their income every year. And that is not sustainable. I don't care if it's student loans or home equity loans or auto loans, people are not going to sustainably be able to spend, and the actual numbers, by the way, are closer to 110 to 115% of the income of the bottom 80% of the population if you really look at these numbers. That's going to stop. And when that stops, we're going to have a serious recession, and it's going to get transmitted overseas just as the first recession did. And, of course, as demand falls, you're going to get a related balance sheet crisis for the companies and a related financial crisis, and countries that have to borrow overseas in the face of this lack of demand are going to be in real trouble. So this is coming. We are in the middle of it. The imbalances are still there. They are real imbalances that nobody is essentially doing anything about. Now, I want to show you for the country where this has happened without a financial crisis for a long time, what's going on. And this is Japan versus the United States. Overall output growth is a combination of growth in hours worked and productivity growth. What this part of the chart shows is the growth in hours worked in Japan for those periods versus the United States. Look at how stable the difference is. That difference doesn't change. Hours worked in the United States grows about 1.5% faster than hours worked overseas throughout this whole period. The problem post-1990 is not demographic. The problem post-1990 is that pre-1990 productivity growth in Japan is about 2.5 to 3% faster than the U.S. Post-1990, and it doesn't happen immediately, Japanese productivity growth falls about 0.5% below the U.S. That is a 3% growth differential entirely related to productivity growth. Why does that happen in Japan? And that is the heart of the whole problem in Japan. It does not look like a demand problem because even though hours of work are falling, by the way, the work population is falling actually slightly faster. It's not a question of not having enough workers. It is a question of productivity growth disappearing because Japan has been focusing on a dying sector, which is manufacturing. The United States has a very vibrant service sector, and as manufacturing productivity growth improves and labor input to manufacturing disappears, just as in the case of a lot of agriculture, the production moves to the home market, to the local markets. Although, by the way, the employment doesn't, the employment just disappears. When General Motors got in trouble in 1980-81, they had 360,000 workers in North America. Today, when they got in trouble, they're now below 30,000 workers, and they produce half as many cars. That means the advantage of cheap labor is about 1/5 of what it was before, and it's getting smaller and smaller over time. This squeeze on manufacturing and the export-led models is only going to get worse, and they're going to have to try harder. Now, this is what happened in manufacturing. You do see these extraordinary big drops here post-1990 in hours worked in manufacturing. That is bizarre, because manufacturing is an export sector. It should not be driven by domestic Japanese demand. This is the global condition of manufacturing, and since you're in the position of getting rid of lots of workers, productivity growth, which was about 2% above the US, is now 0.7% below. These are deep structural problems, and it hasn't been finance related in Japan for at least 10 years. So you can't blame it on that. That's the first part of it. Am I out of time? I don't see any clock restricting me, and trust me, if I don't, I'm not stopping. I'm like a politician or a good academic. My idea of a good conversation is I talk and everybody else listens. But I can stop there. What I was going to talk about briefly was the fact that monetary policy at the same time has been absolutely eviscerated. And it helps to remember what monetary policy looked like when it was powerful. And this is the chart. This is change in money supply a year before, change in nominal GDP a year later. I leave you to look at it, but the correlation is extraordinary. And in particular, when you have a decline in monetary growth between have I got this right? Basically from 1962 to 63, you get a drop in nominal GDP growth when you're starting a war. And that is an extraordinary tribute to the power of monetary policy. You got a drop in nominal GDP in 1963 in response to monetary policy. In 66, 67, you have a drop in the rate of growth of the money supply, and a year later, near the peak of that war, you have a significant drop in nominal GDP. It was extremely powerful. You come to the 90s, the monetary changes are more extreme and they have no visible impact on nominal GDP. You have to ask yourself what happened. And I think that Scott's answer is part of it post this period, but it doesn't account for the power of monetary policy there. If you ask what changed, in the old days, banks were not allowed to pay interest on demand deposits. That was a tax on depositors and a subsidy to the banks. They never shrunk the deposit base so that it was permanent financing, and they never had to pay any interest on it. So it was non-dividend paying equity financing, and it was completely controlled by the government. Since equity is the principal way that firms absorb risk or banks absorb risk lending to firms, this is an extraordinarily powerful and invisible injection of equity finance into the economic system, taxing depositors, giving the equity to the banking system. And it has very powerful effects. By the time it goes away and you're left with just Scott's effect, it has no impact. So when Alan Greenspan climbs into the seat of this car, which is very hard historically to keep on the road, he's moving the wheel all over the place. The car stays on the road because the wheel is no longer connected to the steering, and he thinks he's a genius. And that seems to have persisted, obviously, beyond this. It's not, by the way, changes in, let me just get through all this. This is the consequence, though, of getting rid of that. This is bank credit, which is institutional external credit, as a fraction of overall non-financial business borrowing. And what you can see is that historically, it's about 22 to 25%, 23 as late as 1983. Once the inflation gets rid of that cap on demand deposits, you see a steady decline to 15.5%, and then through the crisis to 13%. The banks are irrelevant to financing businesses these days. And there's no impact of the Fed on the bank willingness to lend, which I think is now Scott's argument, which is what you're left with now that you no longer have this tax and subsidy system. So worry about the real economy. Don't bother yourself about the banks. They're not going to help and they're not going to hurt, but the difficulty is coming. People are not going to spend, and the bottom 80% of the population in the United States, 110% of their income forever. I hope that's at least some new economic thinking.